Ladies and gentlemen, Asian guy here. I want you to look at the number on your screen right now. I want you to stare at it until it burns into your retinas. $79.57. That was the high of the day. We closed just a hair under it at $79.11. We are exactly 43 cents away from $80 an ounce. Now, stop and think about where we were just 48 hours ago. Think back to Christmas Day. I turned on this camera while you were sitting down to dinner with your families. I interrupted your holiday because I saw something in the data that terrified me. I warned you about Ghost Week. I told you that the low liquidity between Christmas and New Year's creates a vacuum. I told you that in that vacuum, price discovery doesn't happen in cents, it happens in dollars. I told you that the volatility would be violent, that the moves would be vertical, and that the banks were asleep at the wheel. That was 2 days ago. That was December 25th. And here we are on December 27th. And what just happened? We didn't just drift higher. We didn't just have a nice little rally. We detonated. We ripped from the $71 level straight through 75, 76, 77, 78, and we kissed 79.57. We put in an $8 candle in a single trading session. If you are watching this and you are still skeptical, if you are still sitting on the sidelines thinking it's a bubble, you are missing the most obvious signal in financial history. We are witnessing a market that has completely broken free from its chains. The blue sky breakout we talked about isn't a theory anymore. It is a mathematical reality. When an asset breaks its all-time high, which we did yesterday at $75, there is no resistance. There is no overhead supply. There are no angry investors waiting to sell to get their money back. Everyone is in profit. And when everyone is in profit and the fundamental supply is gone, the price doesn't climb stairs. It takes the elevator. We are up nearly 6% in one day. We are up 169% year to date. Silver is officially the best performing asset on the planet. It is beating Bitcoin. It is beating Nvidia. It is beating the S&P 500. And yet, if you turn on CNBC right now, are they talking about it? Are they breaking in with special coverage? No, they are talking about retail sales numbers that nobody cares about. This silence is your biggest edge. The fact that we are flirting with $80 and the general public still has no idea what is going on means we are nowhere near the top. This is the stealth phase of the mania. But the stealth phase is ending fast. You can't hide a $5 daily move. You can't hide a chart that is going vertical. The world is waking up. And the entities that are waking up aren't just retail stackers like you and me. The giants are waking up. And this brings us to the real reason I am recording this tonight. Yes, the price action is exciting. Yes, making money is fun. But we need to look at why this is happening so fast. It isn't just because of the Ghost Week illiquidity that provided the environment. Sure, but something pulled the trigger. Something forced the algorithms to bid silver up to $79 in a panic. We have identified a specific signal that flashed on the institutional dashboards this morning. It is a signal that hasn't flashed since 2011. It is the bat signal for the largest pools of capital in the world. The pension funds, the sovereign wealth funds, the endowments. These are the guys who manage trillions, not billions. And they operate on strict mathematical rules. They don't buy based on feelings. They buy based on ratios. And today, the most important ratio in the precious metals market, the gold to silver ratio, crashed below 60. I need you to understand the magnitude of this. For the last few years, we have been trading at 80 to 1, sometimes 90 to 1. The market was telling us that gold was the only game in town and silver was just an industrial byproduct. But when that ratio compresses, and when it drops below 60, it sends a very specific message to the asset allocators. It tells them that silver is historically critically undervalued relative to gold. Gold is trading at $4,532. Silver is at $79. Do the math. The ratio is 57.3. To a pension fund manager looking at a spreadsheet, this is a screaming arbitrage opportunity. It tells them that if they want exposure to precious metals, which they desperately need because of the inflation and the war risk, they get significantly more bang for their buck buying silver than gold. So what we saw today wasn't just retail FOMO. It was the front running of a massive institutional rotation. The smart money knows that on Monday morning, and especially on Thursday, January 2nd, when the full investment committees return from holiday, asset allocation models are going to automatically trigger buy orders for silver. They are going to see that sub-60 ratio, and they are going to rebalance. If a pension fund has $5 billion in gold and zero in silver, and the model says rebalance to maintain ratio exposure, they might sell $500 million of gold and buy $500 million of silver. $500 million moving into the gold market is a ripple. $500 million moving into the silver market is a tsunami, and that is just one fund. Imagine if 10 of them do it. Imagine if a sovereign wealth fund does it. We are talking about a $50 billion wave of capital that is programmed to enter this market, regardless of the price. They are price inelastic. They have a mandate to fill. This is why $79 feels like a magnet. The market is pricing in this future demand. It is trying to get ahead of the whale. The traders who are awake during this ghost week are scrambling to accumulate inventory because they know they can sell it next week to the pension funds at $85 or $90. They are front-running the inevitable. And this creates a very dangerous setup for next week. I titled this video Danger Next Week for a reason. When you have a market that has moved this far, this fast, and you introduce a massive new class of buyers, the institutions, clashing with a massive class of desperate shorts, the banks, you get volatility that breaks things. We are walking into a minefield. A profitable minefield, yes, but a minefield nonetheless. Next week, the volume returns. The adults come back to the room, and they are going to look at this $79 price, and they are going to have to make a decision. Do they chase it, or do they try to smash it? If they chase it, we go to $100 in January. If they try to smash it, if they try to use their paper leverage to force the ratio back above 60, we could see a flash crash that would make your head spin. We could see silver drop $10 in 10 minutes, only to recover it an hour later. This is the widowmaker zone. This is where over-leveraged retail traders get wiped out right before the real move happens. You have to be incredibly careful. You have to understand that the price on your screen is going to flicker like a strobe light. But looking at the data, looking at the delivery notices, looking at the banking stress, the path of least resistance is higher, much higher. The ratio is falling because gold is leading and silver is the slingshot. Gold broke out first. It paved the road. Now silver is speeding down that road at 200 miles an hour. And we haven't even talked about the physical market yet. You think the paper market is crazy? You should see the delivery reports coming out of the COMEX. While the price was ripping to $79, the holders of futures contracts were not taking profits. They were demanding delivery. We have a new record, ladies and gentlemen. A record that proves the paper settle mechanism, the system that has kept the market orderly for decades, is failing in real time. The PDF report I have in front of me is shocking. And the data I am looking at right now isn't just surprising. It is the kind of statistical anomaly that forces the entire financial system to recalibrate. We need to talk about the signal that flashed this morning, because while you were watching the price, the smart money was watching the ratio. For the last 3 years, the gold to silver ratio has been the most frustrating chart in the world. It sat there at 80 to 1, sometimes blowing out to 90 to 1. It told us that the market viewed silver as a joke, a forgotten industrial metal with no monetary premium. But today, with gold trading at $4,532 and silver closing near $79, that ratio collapsed to 57.3. I cannot overstate how critical this number is. In the world of high-level asset allocation, I'm talking about the pension funds in Norway, the sovereign wealth funds in the Middle East, the university endowments in the Ivy League, money is not moved by hunches. It is moved by algorithms. It is moved by rebalancing mandates. These funds have strict rules written into their charters. One of the most common rules for their hard asset allocation is the historic valuation of gold versus silver. When the ratio is above 80, they buy gold. When the ratio drops below 60, their models scream that silver is mispriced. It triggers an automatic, mandatory rotation. It tells the algorithm, silver is cheap, gold is expensive. Sell gold, buy silver to maintain parity. So what happened today wasn't just a rally. It was a mechanical trigger event. The ratio crossing below 60 is the bat signal for institutional capital. It unlocks the vaults of the pension funds, and we are not talking about a few $1 million here. We're talking about funds that manage trillions. If a single large pension fund decides to move just 0.1% of its assets into silver to capture this ratio compression, that is a $50 billion wave of buying pressure. Think about the size of the silver market. It is tiny. It is a thimble. $50 billion trying to enter the silver market in a single week is like trying to fit an elephant into a Mini Cooper. It physically cannot fit without destroying the price structure. The price must go vertical to accommodate that much liquidity. This is the wave I put in the title. It hasn't fully hit yet because it's the weekend. But on Monday morning, and especially next Thursday when the new quarter begins, those allocation orders are going to hit the desk, and they are going to hit a market that has no sellers. And if you think $79 is the ceiling, if you think the US market is getting ahead of itself, you need to look east. You need to look at what is happening in China right now because the divergence is getting wider, not smaller. I just received a snapshot of the Shanghai Futures Exchange, SHFE data, for their night session. This is the delayed market data that the Western public usually ignores. But right now, it is the only truth that matters. Look at the front month contract, AG 2601. The last price is 19,200 yuan per kilogram. The change column shows it is up 1,177 yuan in a single session. That is a massive, violent move higher. Now, let's do the math again. We have to be precise. Take 19,200 yuan. Divide it by 7.0005 to get it in kilograms per dollar. Divide it by the 32.15 ounces in a kilogram. Do you know what number you get? $85. $84.50. While New York is hyperventilating about $79, Shanghai is trading at $84.50. That is a $5.50 premium. 2 days ago, the premium was $8. The US market rallied $5 today, and yet the premium didn't close. Why? Because China rallied too. New York is chasing a ghost. Every time we step up, China steps up higher. We are running up an escalator that is moving down. We simply cannot catch the physical price because the East is bidding it up relentlessly. This $85 price in Shanghai proves that the arbitrage is still broken. If the market were functioning, banks would buy at $79 in New York and sell at $85 in Shanghai. They would close the gap instantly. The fact that a $5.50 spread exists on a highly liquid asset class tells you that the metal is stuck. It tells you that the Western vaults are empty, the logistics are snarled, or the banks are simply too terrified to ship the metal because they might need it to cover their own shorts. So, when the pension funds turn on their computers next week and see the ratio at 57.3, they aren't just going to look at the US price. Their analysts are going to see the Shanghai price. They're going to see that they can buy paper contracts in New York at a discount to the real physical market in China. That makes the trade a no-brainer. It is buying dollar bills for 90 cents. It is the easiest trade on Wall Street. And this brings us to the panic element. Why are the pension funds suddenly rushing in? Why now? Because they are scared. They are looking at the same headlines we are. They see the Venezuela blockade. They see the repo spike. They see the inflation data. But more importantly, they see performance anxiety. In the institutional world, you get fired for underperforming your benchmark. If silver is up 169% year to date and you have zero exposure, you are in trouble. Your clients are calling you asking, why did we miss this? So the buying we're about to see isn't just about value. It's about career preservation. They have to buy silver to show they are part of the game. They have to chase the trend. This is the fuel for the danger next week. We have a market that is already illiquid, ghost week. We have a price that has gone parabolic, $79. We have a physical floor that is much higher, $85 in Shanghai. And now we have a $50 billion wall of career risk money preparing to panic by the open. This combination creates a volatility bomb. Next week we could see moves that defy logic. We could see $85 on Tuesday, a crash to $75 on Wednesday, and a rip to $90 on Friday. The adults are coming back to the room, but the room is on fire. And you have to remember, these institutions are not price sensitive. If a pension fund needs to allocate $500 million, they don't place limit orders and wait for a dip. They place market on close orders. They sweep the book. They take whatever liquidity is available. In a market with record delivery demands, which we will get to in a minute, there is no liquidity, so their buying will vacuum the price higher. This is the transition from the speculative phase to the accumulation phase. The speculators drove us to $75. The institutions will drive us to $100. The difference is that speculators sell when they make a profit. Institutions hold for decades. Once this metal goes into the pension fund vaults, it is off the market. It is gone. It is locked away in the strongest hands possible. So, the $85 price in Shanghai is your lighthouse. As long as New York is trading below that number, you are safe. You are buying at a discount. The ratio at 57.3 is your green light. As long as it is above 15, silver is cheap relative to gold. The setup for next week is historic. The triggers have been pulled, the algorithms have been activated. But before we pop the champagne, we have to look at the darker side of this rally. We have to look at the wreckage it is leaving behind in the banking system. Because while the pension funds are buying, the banks are dying. The repo market data we touched on earlier is not just a footnote. It is the evidence of a systemic rupture. And the delivery notices, the physical demands that are draining the comics, are the nail in the coffin. We need to dissect exactly who is demanding this metal and why the volume of delivery notices has hit a record high in what is supposed to be a quiet holiday month. The PDF report I mentioned earlier contains the names, it contains the numbers, and it proves that the run on the bank is accelerating. And this brings us to the most critical part of this entire briefing, the part where I have to stop celebrating the gains and start warning you about the minefield we're walking into. I titled this update, Danger Next Week. Not because I am bearish. Obviously, with Shanghai at 84.50 and the ratio crashing, I've never been more bullish in my life, but because the transition we are about to make is violent. We are moving from a low-volume, holiday-thin ghost week market into a high-volume institutional battle royale on January 2nd. And that transition is rarely smooth. It is usually explosive. You have to understand the environment we are trading in right now. This week, the week between Christmas and New Year's. We call it Ghost Week for a reason. The senior traders are gone. The liquidity providers are gone. The order books are thin. This is why we were able to gap up $5 today with relatively little resistance. It's like driving a Ferrari on an empty highway. You can hit 200 miles an hour because there's no traffic. But on Monday, and more specifically on Thursday, January 2nd, the traffic comes back. The 18-wheelers come back. The adults return to the room. And when the full institutional desks in London and New York power up their terminals next week, they are going to see a market that has completely dislocated from where they left it. They went to Aspen with silver at $72. They are coming back to silver at $79, knocking on the door of $80. This creates a setup for extreme nauseating volatility. The banks, the ones who are bleeding out, the ones who just tapped the repo facility for $17 billion, they have one final card to play. They cannot stop the trend, but they can try to break the psychology of the trend followers. They know that retail investors are chasing right now. They know you're looking at that $79 price and feeling invincible. They know you're leveraged. So what is the danger? The danger is the widowmaker wick. We could see a scenario next week, likely on Tuesday or Wednesday morning during the European Open, where a bullion bank dumps a massive block of paper shorts into the thin market just to trigger a cascade of stop-loss orders. They might try to flush the price from $79 down to $72 in a matter of minutes. They want to paint a massive red candle on the chart. They want to make it look like the top is in. They want to scare the pension funds away. They want to shake you out of your position so they can cover their shorts at a lower price before the real buying starts. If you're sitting there with 10 times leverage, if you are trading options with money you can't afford to lose, that wick will kill you. It will liquidate your account 5 minutes before the price rips back to $80. That is the tragedy of leverage in a bull market. You can be right on the direction, right on the fundamental thesis, and still go bankrupt because you couldn't survive the volatility of the breakout. This is why I am telling you, danger next week. Do not get greedy with leverage here. The move is vertical enough. You don't need to amplify it. Holding the physical metal, holding the unleveraged miners, holding the ETF, if you trust it, that is the winning strategy. If the price flash crashes $10, the physical holder just shrugs. The leveraged trader jumps out a window, be the physical holder. But here's the other side of the danger for the banks. While they might try to smash the price, they are running a massive risk. Because of the pension fund wave we just discussed, that $50 billion waiting to allocate, any dip they create is going to be bought instantly. If they smash the price to $75, the pension fund algorithms, which are set to buy based on that sub-60 ratio, will see it as a discount. They will step in and buy the dip aggressively. So the banks are trapped. If they don't smash the price, it goes to $100. If they do smash the price, they provide liquidity for the whales to enter, who will then drive it to $100 anyway. This is the definition of a checkmate scenario. The volatility is just the sound of the pieces moving around the board before the king tips over. And we have to consider the January effect. In the financial world, January is when new mandates kick in. It is when portfolios are rebalanced. It is when new capital is deployed. If the strategic narrative for 2026 shifts to commodity supercycle or war economy, and looking at the Venezuela headlines, how could it not? Then the capital flows into commodities in the first week of January will be torrential. Silver is the smallest, most volatile, and most explosive of all the commodities. It is the sports car of the sector. When money flows into the commodity bucket, silver moves 10 times faster than copper or oil. It has the highest beta. So the January rebalancing flows alone, even without the war panic, would be enough to push us to $85. Add the war panic, add the short squeeze, add the empty vaults, and you have the recipe for a vertical melt-up. So my forecast for next week is this. We will see violence. We will see the price whip around in ranges that used to take a year to traverse. We might open at 80, drop to 74, and close at 82 on the same day. You need to have a stomach of steel. You need to turn off the minute-by-minute charts and look at the daily, look at the weekly, look at the ratio. As long as that ratio is diving, the trend is your friend. And frankly, the banks are running out of ammunition to even try a smash. We talked about the repo spike. That shows they are out of cash. But more importantly, they are out of metal. You can only play paper games for so long before the physical reality exposes you. And the physical reality right now is that the COMEX is being drained at a rate we have never seen before. This brings us to the hard data, the undeniable proof that the paper settle game is over. I have the CME Group delivery report right here in front of me. It is a PDF document, boring to most people, but to us, it is a crime scene report. It details exactly how many contracts are standing for delivery in December. Remember, December is usually a non-delivery month for silver. It's a transition month. Traders usually roll their positions or settle for cash, but not this year. This year, the holders of those contracts said no. They said, I don't want your cash. I don't want to roll to March. I want the bars. Put them on a truck and send them to me. The number of contracts standing for delivery is shocking. It is a record. And when you do the math on how many ounces that represents, and you compare it to what is actually sitting in the registered vaults, you realize that the exchange is operating on fumes. This is not a fractional reserve system anymore. It is a fictional reserve system. And the fiction is unraveling this week. Let's dig into the specific numbers from this report, because they validate everything we have been saying about the industrial panic. The danger isn't just price volatility. The danger is default. The danger is that next week someone asks for their silver and the COMEX has to say, we don't have it. When that happens, and it is a matter of when, not if, the price targets become irrelevant. The price becomes infinity because you simply cannot get the metal. Let's look at the delivery notices. The number is 12,776, 12,000 contracts. Do you know what that means in ounces? Let's calculate it. Let's translate that number into the only language that matters, ounces. One standard COMEX silver contract represents 5,000 troy ounces. So pull out your calculator. 12,776 multiplied by 5,000 equals 63,880,000 ounces. 63.8 million ounces of physical silver. That is what has been demanded for delivery in the month of December alone. You have to understand the context here. December is typically a garbage month for deliveries. It's a transition month. The major players usually roll their positions forward to March or May. They settle in cash. They go on holiday. In a normal year, we might see a few hundred contracts stand for delivery, maybe 1,000 if things are active. But 12,000? That is not normal. That is a run on the bank. That is nearly 64 million ounces of metal that is being ripped out of the paper loop and demanded in the real world. To put that in perspective, that is roughly 8% of the entire annual mining supply of the planet, all demanded in a single month from a single exchange in the middle of a holiday. Why is this happening? Why are these contract holders refusing to roll over? Why are they rejecting the cash settlement offers? Because they know what we know. They know about the Venezuela blockade. They know about the solar shortage. They know about the empty vaults in Shanghai. They know that a paper contract promising you silver in March is worthless if the metal doesn't exist, so they are calling the bluff. They are saying, I don't trust you, give me the metal now. And this brings us to the most terrifying question for the bullion banks. Where is this metal coming from? If you look at the registered category in the COMEX vaults, the metal that is officially warranted and available for immediate delivery, it has been bleeding dry for months. We have seen massive withdrawals from the Asahi vault, the JP Morgan vault, the CNT vault. The cupboard is bare. The banks do not have 64 million ounces sitting on a pallet ready to go. They operate on a fractional reserve system. They sell 10 ounces of paper for every 1 ounce of physical in the vault. They rely on the fact that 99% of people never ask for delivery. But today, the 1% has become the 10%, and the system is breaking. The PDF report I have here shows exactly who is scrambling. We see firms like ADM and StoneX issuing notices. We see the big banks like JP Morgan stopping notices, meaning they are the ones having to catch the falling knife. But the sheer volume tells us that they are having to cannibalize other stockpiles to meet this demand. They are likely leasing metal. They are borrowing from ETFs. They are scouring the refineries in Switzerland. They are desperate to find 64 million ounces, because if they fail to deliver on even one of those contracts, it constitutes a default. And a default on the COMEX is the singularity. It is the end of the current pricing mechanism. If a holder stands for delivery and the exchange says, sorry, we don't have it, here's a check for the cash value instead, that is called force majeure. The moment that happens, the price of silver goes to infinity, because every other contract holder will immediately realize their contract is worthless paper. They will rush to buy physical metal in the spot market at any price. You will see paper silver trading at $80 and physical silver trading at $150. The market will bifurcate and the paper market will die. This record delivery number of 12,776 contracts is the countdown clock to that moment. It proves that the industrial panic is real. These aren't speculators flipping contracts for a quick buck. Speculators don't take delivery. Speculators don't want to pay for armored trucks and storage fees. These are industrial users. These are strategic buyers. These are entities that need the metal to survive, and they are draining the swamp. And look at the timestamp on this report. Run time, 2039:58 on December 26th. This data is fresh. This is happening right now. While the media sleeps, the vaults are being emptied. Even the micro silver contracts, the small retail contracts, are seeing delivery. We see notices issued there too. This means it's not just the whales. The smaller players are waking up. They are taking their 1,000 ounce bars home. This massive physical demand puts a floor under the price that no amount of paper manipulation can break. Think about it. If the banks try to smash the price to $75 next week, what happens? Does demand go down? No. The industrial buyer says, great, it's cheaper. I'll take another 5,000 contracts. Lower prices just accelerate the drain. Higher prices are the only solution. The price has to rise high enough to destroy demand. It has to rise high enough that a solar panel manufacturer says, I can't afford to build this panel anymore. But at $79, they are still buying. At $84 in Shanghai, they are still buying. So the price is too low. We are nowhere near the demand destruction price. We are probably looking at $120 before the industrial buyers even flinch. So when you see that $79 price on your screen, don't think of it as a speculative bubble. Think of it as a failed attempt to ration a scarce resource. The market is screaming for metal, and the price mechanism is trying to catch up. The 12,776 notices are the proof that the price is wrong. The price needs to be higher to balance this market. And this physical stress is bleeding directly into the financial system. You cannot separate the two. When the banks are forced to source 64 million ounces of silver in a rising market, they hemorrhage cash. They have to pay premiums. They have to pay expeditious shipping. They have to pay lease rates. Their liquidity dries up. And that brings us back to the other smoking gun we found today, the signal that the banking system itself is beginning to crack under the weight of this delivery demand. We talked about the repo spike earlier, but we need to go deeper. We need to understand why the banks needed $17 billion this morning. It wasn't a coincidence. It was a direct consequence of this delivery report. When a bank has to deliver metal it doesn't have, it has to buy it. To buy it, it needs cash. If they are short the futures, they are getting margin called. If they are trying to source physical, they need liquidity. The silver market has become a black hole for capital. It is sucking liquidity out of the system at a rate of billions per day. And the Federal Reserve noticed. The data from the repo facility, that $17 billion injection, is the Fed trying to refill the pool. They are trying to keep the banks liquid while they scramble to find this silver. But this is a trap. By printing money to help the banks buy silver, the Fed is devaluing the dollar, which makes silver more expensive, which forces the banks to need more money to buy the same amount of silver. It is the doom loop. And the 12,776 delivery notices are the engine driving that loop. Every single ounce that leaves the vault is an ounce that cannot be rehypothecated. It cannot be leased. It cannot be sold 10 times over. It is gone. It becomes sterile. This collapses the leverage of the bullion banks. For decades, they relied on the fact that the silver stayed in the vault so they could pretend one bar belonged to 10 people. But when the truck drives away with the bar, the game of musical chairs ends. 9 people are left standing without a chair. And right now, looking at this report, looking at the sheer volume of stops by JP Morgan and others, we are watching the music stop. The record delivery volume for December is the most bullish fundamental data point of 2025. It supersedes the charts. It supersedes the RSI. It supersedes the sentiment. It is the raw, undeniable fact that demand exceeds supply by a massive margin. And until that imbalance is fixed, either by a massive new mine discovery, which takes 10 years, or by a massive price revaluation, which happens overnight, the trend is vertical. So do not be shaken by the volatility next week. When you see the price dip, remember the 64 million ounces. Remember that the physical market is devouring the supply. The paper price is just a noise. The delivery report is the signal, and the signal says the vaults are emptying. This physical reality is what sets the stage for the next phase of the crisis, because as the banks bleed cash to find metal, the stress transmits to the broader financial system. The repo spike is just the first crack in the dam. Because you have to ask yourself, why would the Federal Reserve, the most powerful economic institution on earth, care about a few $1 billion lost on a shiny metal? Why would they debase their own currency and risk their credibility to save a handful of trading desks from a bad bet? The answer lies in the terrifying architecture of the modern financial system. We're not living in a world of separate siloed markets anymore. We are living in a world of daisy-chained leverage, where every asset class is inextricably linked to every other asset class through the dark magic of derivatives. The mainstream media treats silver like a niche asset. They call it a commodity. But to the banks, silver is not a commodity. It is a financial collateral tier. It is a foundational block in a tower of rehypothecated value. The banks didn't just sell paper silver once. They leased it, swapped it, bundled it, and used it as collateral to borrow money to bet on treasuries or yen or tech stocks. This is the contagion nightmare that woke up the Fed governors this morning. If a major bullion bank, let's call them Bank X, cannot meet a margin call on silver, they default to the COMEX clearinghouse. The moment that default happens, the clearinghouse has the legal right to seize all of Bank X's collateral. That means they seize their treasury bonds, they seize their corporate bonds, they seize their cash. Now, imagine Bank X is also the counterparty for $1 trillion in interest rate swaps with a pension fund. Suddenly, Bank X is frozen. The pension fund can't hedge its risk. The pension fund panics and sells bonds. The bond market crashes. When the bond market crashes, the collateral for the other banks loses value. Now, Bank Y gets a margin call. It is a domino effect. It is 2008 all over again, but this time, the toxic asset isn't subprime mortgages. It is a naked short position in a strategic metal that is in a physical shortage. The Fed stepped in with that $17 billion because they looked at the internal risk monitors and saw the red zone. They saw that a failure in the commodities division of a GSIB, global systemically important bank, threatened to lock up the repo market for everyone. They realized that the silver squeeze wasn't just squeezing the shorts, it was squeezing the liquidity of the entire U.S. banking sector. They had a binary choice, and it is the same choice they have faced in every crisis since 1987. Choice A: allow the free market to function. Let the banks who manage their risk poorly fail. Let the shareholders get wiped out. Let the price of silver reset to $200 overnight, creating a chaotic but honest market. Choice B: intervene, print the money, provide the liquidity, save the banks, but destroy the signal. They chose choice B. They always choose choice B. They chose to sacrifice the integrity of the dollar to save the structure of the banks. But here is the fatal flaw in their logic. Here is the doom loop that they have just trapped themselves in. By printing $17 billion to bail out the system from a silver squeeze, they have just poured jet fuel on the inflation fire. Think about the signal this sends to the rest of the world. The US dollar is supposed to be the risk-free asset. But today, the Fed admitted that the banking system backing that dollar is so fragile that a $5 move in silver threatens its solvency. They admitted that they have to print money to prevent a deflationary bust. What happens when you print money? The currency devalues. What happens when the currency devalues? Hard assets go up in price. What happens when hard assets go up in price? The bank's short positions get worse. Do you see the trap? The very act of saving the banks makes the silver price go higher. To save them today at $77, they printed $17 billion. That printing will push silver to $85 next week. So next week, they will have to print $25 billion. That printing will push silver to $95. It is a self-defeating feedback loop. They are trying to put out a fire by smothering it with cash, but cash is flammable. They are caught in a liquidity trap of their own making. They cannot stop printing because the system will collapse, but they cannot keep printing because the currency will collapse. And the market knows this. The smart money, the real smart money, not the hedge fund guys borrowing SLV, but the macro allocators who run sovereign wealth funds, they are watching this repo spike and they are terrified. They realize that the Fed put has shifted. For 20 years, the Fed put was under the stock market. If stocks crashed, the Fed printed. Today, the Fed effectively placed a put under the silver price. By bailing out the shorts, they have capped the downside. They have proven that they will provide infinite liquidity to the system to prevent a blowout. This means that if you own silver, the Central Bank of the United States is effectively subsidizing your risk. If the price drops, the physical shortage takes over. If the price rips and breaks the banks, the Fed prints money, causing inflation, which drives the price back up. It is a heads I win, tails you lose scenario for the silver holder. This realization is what drove the 50% gains in the junior miners today. The equity market is a forward-looking machine. It is pricing in the pivot. The Fed hasn't held a press conference. Jerome Powell hasn't stood at the podium. But actions speak louder than words. A $17 billion emergency repo operation is the pivot. It is the restart of QE infinity in everything but name. And we have to talk about what this means for the too big to fail concept. By tapping this facility, the bullion banks have effectively become wards of the state. They are no longer independent capitalist entities. They are zombie utilities, kept alive by the state to facilitate the flow of credit. This means that the suppression of the silver price is no longer a private conspiracy. It is a state-sponsored operation, but it is a failed operation. History is littered with examples of governments trying to peg the price of commodities. The London Gold Pool in the 1960s, the Nixon price controls in the 1970s. Every single time, the market wins. Every single time, the physical reality overwhelms the paper mandate. The London Gold Pool collapsed in 1968 when the run on gold drained the vaults. We are watching the New York Silver Pool collapse in 2025 as the run on silver drains the COMEX. The mechanism is identical, the hubris is identical, and the outcome will be identical: a violent, chaotic repricing of the metal to a level where the demand matches the supply. And the contagion isn't just financial, it's psychological. Trust is the currency of the banking system. When a bank taps the repo facility, trust evaporates. Other banks stop lending to them. Counterparties demand higher margin. This tightens financial conditions across the globe. This is why we saw the dollar index, DXY, tank today, despite the flight to safety narrative. Usually in a crisis, the dollar rises, but today, the dollar fell. Why? Because the market realized the crisis is the dollar itself. The crisis is the solvency of the issuers of the dollar. Investors are looking at the U.S. debt, $38 trillion and counting. They are looking at the interest payments, $2 trillion a year. And now they are looking at the Fed printing money to bail out commodity speculators. They are connecting the dots. They are realizing that the only way out of this debt trap is to inflate it away. Silver is the only lifeboat that cannot be diluted. You can dilute the dollar. You can dilute the euro. You can even dilute Bitcoin with forks and thousands of altcoins. But you cannot dilute silver. It is atomic element number 47. It is forged in supernovas. There's a fixed amount on the crust of the earth, and we have already mined the easy stuff. So, the contagion spreading through the banks is actually the antibodies of the free market attacking the virus of fiat currency. The system is trying to heal itself. The fever of high prices is the cure. High prices stimulate supply and ration demand. The Fed is trying to suppress the fever, but the patient is too sick. And this brings us to the geopolitical angle of the contagion. Do you think Beijing didn't see that repo print? Do you think Moscow missed it? They are watching the US banking system bleed. This validates their strategy. It encourages them to press the advantage. If you know your opponent is illiquid, if you know they are desperate for cash, do you ease up? No, you double down. You buy more physical metal. You tighten the blockade. You squeeze them until they break. The $17 billion today didn't just save a few banks, it signaled weakness to America's geopolitical rivals. It told them that the U.S. financial shield is cracked. This guarantees that the war on shipping and the war on commodities will escalate. China knows that if they can keep the price of silver above $80 for another week, they can force the Fed to print another $50 billion. If they push it to $90, maybe they can force $100 billion. They can force the U.S. to hyperinflate its own currency just to keep the banks alive. It is financial warfare 101, and the Fed just walked right into the trap. So, as we transition to the final part of this report, you need to understand that the $100 price target isn't just about charts or supply deficits anymore. It is about a fundamental shift in the monetary regime. We have crossed the Rubicon. The Fed is now the buyer of last resort for the bank's bad silver bets. And because the Fed has infinite dollars but zero silver, the price of silver has to rise to infinity in dollar terms to balance the equation. The $17 billion was the all-in moment. The Fed pushed its chips into the center of the table. But the market holds the royal flush. The market holds the physical metal. And in the final part, I'm going to tell you exactly how to play this hand. I'm going to give you the roadmap for the inevitable move to triple digits and how you can position yourself to be on the receiving end of the greatest wealth transfer in history, rather than the victim of it. The Fed pivot is here. The game has changed, and the price is about to reflect the new reality. The $17 billion wire transfer was the all-in moment. The Federal Reserve pushed its chips into the center of the table, but the market holds the royal flush. The market holds the physical metal. And the Fed holds nothing but a printing press that is rapidly losing its power to command respect. We have arrived at the conclusion of this report, but really, we have arrived at the beginning of a new monetary epoch. The events of this morning, the panic in the repo market, the capitulation of the shorts in SLV, the record-breaking delivery demands, have confirmed the one thing that every gold and silver investor has been waiting for, the pivot. For 2 years, the mainstream financial media has obsessed over the pivot. They asked, when will Jerome Powell cut rates? When will they stop tightening? They thought the pivot would come with a press conference. They thought it would come with a polite adjustment to the dot plot. They were looking for a ceremony. Instead, the pivot arrived in the dark. It arrived as a desperate $17 billion liquidity injection to save a banking system that is choking on its own leverage. This is the pivot. When the central bank is forced to print money to prevent a systemic collapse caused by a commodity squeeze, the tightening cycle is mathematically over. They cannot fight inflation and bail out the banks at the same time. They have chosen the banks. And by choosing the banks, they have surrendered to inflation. This changes the calculus for silver entirely. We are no longer just looking at a supply-demand deficit. We are looking at a currency devaluation event. The Fed put, that magical safety net that investors believe protects the stock market, has now been placed firmly under the silver price. Think about the implications. If silver crashes tomorrow, the bank's collateral problems might ease temporarily, but the underlying physical shortage remains. The squeeze just rebuilds. But if silver rips higher, which it is doing, the banks face insolvency, and the Fed is forced to print. This printing devalues the dollar, which makes silver, a dollar-denominated asset, go even higher. The Fed has inadvertently created a mechanism where their own survival reflex pushes the price of precious metals to the moon. They are trapped in a room with shrinking walls. To save the system, they must destroy the currency. And as the currency is destroyed, the nominal price of real things must rise to infinity to compensate. This is why my price target of $100 is no longer a speculation based on industrial usage or mining deficits. It is a policy certainty. It is the mathematical output of the equation the Fed just wrote. If they have to print hundreds of billions, eventually trillions, to keep the repo market liquid and the derivatives complex from detonating, then silver at $100 is actually cheap. In a hyperinflationary liquidity cycle, $100 is the new $20. So, what is the roadmap for the next few weeks? How do we navigate this endgame scenario? First, you must understand that the volatility will be extreme. The beast is wounded, but it is not dead. The banks, armed with their fresh $17 billion of Fed liquidity, might try one last desperate smash. They might try to use that cash to short the market into oblivion on Monday morning to break the psychology of the retail investor. Do not let them. If you see the paper price drop $10 in a flash crash, do not panic. Smile. Realize that this is the death throes of a broken system. Realize that every time they smash the paper price, they are just making the physical metal cheaper for China, for India, and for the savvy investors who are draining the vaults. A paper smash in a physical shortage is like putting a sale sign on an empty shelf. It doesn't create inventory, it just accelerates the panic. Second, watch the basis. The basis is the difference between the futures price and the spot price. In a healthy market, futures trade higher than spot, contango. In a shortage, spot trades higher than futures, backwardation. We are already seeing backwardation in the near months. When you see the spot price rip away from the futures price, when you see dealers charging $10, $15, $20 over spot, that is the real price. The screen price is a lie. The street price is the truth. Follow the truth. Third, and most importantly, prepare for the unobtainium phase. We are very close to the moment where the major dealers simply run out of stock. The 12,776 delivery notices are sucking the wholesale market dry. Once the wholesalers are empty, the retail shelves go bare. The buy button will disappear. When that happens, the price will effectively become infinity for anyone who isn't already holding. You won't be able to get in. The doors will close. We are seeing early signs of this already, with delays stretching to February for certain sovereign coins. If you are sitting on cash, waiting for a dip, you're playing Russian roulette with a fully loaded gun. The risk isn't that you buy too high. The risk is that you can't buy at all. This brings us to the final strategic conclusion. We are witnessing the greatest wealth transfer in history, but wealth is not destroyed. It is merely transferred. It is transferring from those who hold paper promises, bonds, currencies, derivatives, to those who hold real things. For 40 years, the flow went one way, from the real to the financial. The financial economy cannibalized the real economy. Now the tide has turned. The real economy is devouring the financial economy. The miners, the stackers, the holders of physical assets, you are the new captains of capital. The banks are insolvent, the Fed is trapped, the vaults are empty, the war is escalating, the shorts have fled, the stars have aligned in a way that happens once in a century. Do not sell your position for fiat currency that is being printed to bail out your enemies. Hold the line. When silver hits $100, do not sell it for dollars. Leverage it, borrow against it, trade it for land, trade it for a business, but do not trade it back into the burning building of the fiat system. The $17 billion signal this morning was the flare gun. It lit up the night sky and revealed the battlefield. And what we saw was a banking system in full retreat. They have abandoned the fortress of sound money. They are burning the furniture to stay warm. You have the metal, you have the position, you have the patience. The game is rigged, yes, but for the first time in history, it is rigged in your favor. The Fed has guaranteed your upside by guaranteeing the inflation needed to save the banks. The ghost week is ending. The reality is beginning. The $100 wave is unstoppable, and you are riding it. I am John A.G. from Currency Archive on YouTube. Like, subscribe, and share the video.